Hi, Assalamualaikum and hi everyone. My name is Puteri Alia Bajismiti Nagar Aizam. My metric number is 25002755. And now me and my friends will explain to you guys about our business, which is Aurelia & Co. As for the introduction, Aurelia & Co. is a retail business specializing in the resale of the jewelry, curating collections from trusted suppliers to deliver exclusivity, authenticity, and heritage, making our product both emotionally meaningful and financially valuable. Despite economic pressures, demand for affordable luxury remains strong, especially among younger professionals and students who view jewelry as a lifestyle investment. Our reseller model means shifting consumer preference for transparency and personalized experiences, while cultural traditions ensure consistent demand across generations. By combining curated luxury pieces with exceptional service, Aurelia & Co. is positioned to build a sustainable presence in the resilient luxury jewelry market. And now, let's move on to the industry analysis and risk assessment. Aurelia & Co. competes with established retailers, boutiques, and online platforms in the luxury jewelry sector. We differentiate through curated collections and personalized service, targeting professionals and students seeking affordable luxury. Key risks include shifting fashion trends and inventory drift, which we address by updating designs regularly and enforcing strict security measures. And with this strategy, we are positioned to grow sustainably in a competitive market. Now, let's move on to the objective of managerial accounting for our business. The first one is planning and decision making, followed by directing controlling activities, motivating employees, measuring performance across channels, assessing competitive positions, and managing risk. As for startup capital, our business has 250,000 capital at the beginning of our business, and we did allocate our capital to a different item, which is for initial merchandise inventory is 80,000 ringgit, store renovations and branding 100,000 ringgit, rental deposit 25,000 ringgit, marketing launch 20,000 ringgit, packaging and supplies 10,000 ringgit, and cash reserve 15,000 ringgit. So that's all from my part, and I will pass to my friends to introduce more about our business. Thank you, everyone.
Hello everyone, my name is Nurzahira Izzati and I will be talking about Aurelia & Co.'s budgetary process and its impact on the master budget. Aurelia & Co. implements a participative budgetary process where each department prepares its own budget and moves it up to top management, creating a company-level budget. This approach shares the responsibility with lower-level managers, giving them a sense of ownership, making them feel valued and included. Involving employees also keeps them motivated to achieve business goals. This approach tends to produce realistic and attainable budgets because employees are positioned to inform the supervisors on allocation of funds. Now, the impact of implementing participative budget improves accuracy because the budget is reviewed at every level, and at the same time, it helps identify costs that leads towards wastage and inefficiencies, ensuring effective cost control. With employees' knowledge on costs involved, it produces accurate and practical estimates, reducing budget variances during execution. Now, I will be explaining how big data influences our budgeting. Firstly, Aurelia & Co. uses big data to analyze purchasing patterns and sales forecasting. We analyze business transactions to determine which of our products generate higher revenue, resulting in more accurate sales forecasts and better allocation of inventory. In addition, big data also helps our business's operational planning. Through historical transaction data, we are enabled to allocate funds to departments that need them the most, ensuring both production and departmental needs are used effectively and operations will run smoothly. And lastly, Aurelia & Co. uses social media on customer insights. By monitoring platforms such as Instagram and TikTok, our business can identify current trends, styles, and even customer preferences. This helps us stay ahead of market trends and ensure our product remains relevant. Overall, this enables Aurelia & Co. to introduce new ideas and designs that can strengthen brand loyalty and increase customer satisfaction.
Assalamualaikum and hi everyone. My name is Nur Alisha. My matrix number is 240000555. Today I will present the master budget for Aurelia & Co. for the year ending 2025, focusing on our sales and purchasing strategy. First, let's look at our strategic environment. So, Aurelia & Co. targets the upper middle to high income demographic, age 25 to 45. We have positioned ourselves away from price wars. Instead, we are using differentiation strategy. If you look at our pricing in Schedule 1, we have set premium price points such as RM220 for a necklace and RM150 for bracelets. These prices signal quality and craftsmanship to our customers. This allows us to protect our margins against industry pressures such as rising raw material, costs, and ethical sourcing demands without sacrificing brand image. Moving to Schedule 1, our sales budget, we are projecting total annual revenue of RM468,000 ringgit. But the pacing of this revenue is critical. We haven't forecasted an unrealistic instant boom. Instead, we see steady growth. In Quarter 1, we start conservatively with revenue of 59,000 ringgit 600 as we deploy our RM20,000 for a launch campaign. By Quarter 4, however, we projected revenue to triple to 185,000 ringgit 200. This steep Quarter 4 curve reflects the jewelry industry's strong seasonality, specifically the year-end gifting rush. You can see this volume growth clearly in our units. For example, necklaces scale from 105 units in Quarter 1 to 330 units in Quarter 4. This confirms our strategy is working. We are building brand loyalty throughout the year to capitalize on peak season demand. Finally, let's look at Schedule 2 to see how we manage risk. So, forecasting always carries uncertainty, specifically inflation that affects our spending or aggressive competitor pricing. To mitigate this financial risk, we have adopted a prudent inventory policy. For example, cost control. We have locked our cost of goods sold at 40% of sales, ensuring a healthy 60% gross margin. Secondly, we used inventory cap. So we are strictly limiting ending inventory to 15% of the next quarter's COGS. For example, looking at the budget, even though our sales skyrocketed in Quarter 4, our Quarter 1 total budgeted costs are kept low at 29,270 ringgit. So this just-in-time approach ensures we have enough stock to meet demand, but we aren't tying up cash in unsold goods. In conclusion, this budget delivers a total sales revenue of RM468,000 ringgit against total budgeted purchase cost of RM202,000 ringgit and 200. We are positioned for profitability through premium pricing and conservative cash management. Thank you.
Hello everyone, my name is Adana Maisara. So, looking at this slide, there is our cost structure. Our cost structure is defined by high operating leverage. Approximately 81% of our SG&A expenses are fixed. While this creates a higher break-even point, it means that once we recover those baseline costs, every additional ringgit of sales yields rapidly accelerating profitability. However, we must monitor our variable expenses, which are projected to triple between the first quarter and also the fourth quarter due to rising commission and also merchant fees. Next, there is our financial and operational risk. As we know, transparency regarding risk is vital. In the first quarter, we faced immediate strain due to the 10,000 ringgit equipment out there during our lowest sales period. By the third quarter, we must manage a rolling liability, which created by our 20% purchase difference. This risk peaked in the third quarter, where liabilities hit their maximum alongside triple variable expenses. Managing this vendor relationship and liquidity buffers will be our primary operational focus. So now, let's begin with our cash receipt budget. For the 2025 fiscal year, we are launching with a solid startup capital of 250,000 ringgit, which our revenue model is based on a staggered collection of 70% of sales are collected in the current quarter and 28% in the following. As you can see, our sales momentum built significantly, starting from the 59,600 ringgit in the first quarter and scaling up to over 185,000 by the fourth quarter. This results in total annual cash collection of 656,784,000. So, moving on to our outflows, our initial quarter is heavy on the infrastructure. We have collected of 185,000 ringgit in the first quarter for startup costs, including inventory, renovation, and marketing. A key detail here is our vendor payment strategy, which we pay 80% of purchase immediately and defer the 20% to the next month. This helps our management short-term liquidity while maintaining steady SG&A operation, which total roughly 237,800 for the year. So, when we consolidate these figures into our summary budget, we see a healthy trajectory, which we start the first quarter with a zero balance, but end up with 53 and 10,000 ringgit after all startup expenses. Despite the heavy spending, we maintain a positive cash position in every quarter, finishing the year with a strong ending cash balance of 65,379.6. This confirms that our initial capital is sufficient to cover our aggressive growth phase.
Hi everyone, I'm going to talk about financial planning and liquidity analysis. Let's begin by looking at our cash flow management. Our cash budget highlights a solid liquidity positions for our business, as is typical in our industry. There's a time lag between paying our suppliers and collecting on our credit sales. This results in some fluctuations in our cash positions. Throughout the year, specifically, we noticed a dip in our cash reserves during the second quarter, primarily due to high disbursements for renovations. However, because of our total cash available consistently stayed above our spending, we successfully maintained a positive balance in every quarter, recovering to a healthy ending cash balance of RM 65,379,060 by year end. Moving to our funding requirements, the data confirms that our initial capital was fully sufficient to support the business. We are pleased to report that we did not require any external financing or loans to maintain operations. Our cash balance remains in the black for the entire fiscal year. We started at zero and through disciplined management concluded the year with over RM 65,000 in the bank, proving that our startup capital was well timed and well allocated. Finally, let's look at the overall financial health of the company. Our budgeted income statements projects a net profit of RM 3,000. While this is a modest figure, it is a significant milestone as it shows the business achieving a break-even position and moving into profitability within its very first year. From a solvency perspective, the business is in a very strong position. Our budgeted balance sheet shows a robust total asset base of over RM 415,000. This is supported by a healthy mix of accounts receivable and our cash reserve. With this level of liquidity, we are confident that the business can comfortably meet all of its short-term obligations as they fall due.
Assalamualaikum and hi, I am Aurelia 240000715 and we are moving on to activity-based costing. We realized that traditional costing will hide the true complexity of our product line. To fix this, we implemented ABC costing for quarter 1 to analyze our 28,250 ringgit in operational overheads. We broke this cost down into 3 strategic activity pools: sales consultation, marketing campaign, and inventory management. You can see here that sales consultation is our largest cost pool at 18,000 ringgit, followed by marketing at 6,000 ringgit and inventory management at 4,250 ringgit. The most critical part of our analysis is the logic behind our drivers. First, for sale consultation, which is our largest cost at 18,000 ringgit. We use consultation hours as a driver. We assume that selling a high-value necklace requires 30 minutes of detailed product education, whereas selling earrings only take about 5 minutes. This ensures we are charging the product for the actual staff time they consume. Second, for marketing campaigns, we allocated costs based on the difficulty of the sale. We focus 50% of our campaign solely on necklaces because finding premium buyers is harder. In contrast, bracelet and earrings rely more on the organic foot traffic. But for our inventory management, we look at restocking batches. High-value items need smaller, secure shipment, while earring and high turnover require frequent restocking. Based on those drivers, we calculated the activity usage for each product line. As you can see in the table, necklaces consume 52.5 hours of consultation time, costing us over 8,800 ringgit in that category alone. In comparison, earrings only consume 70 hours. This detailed calculation ensures that the overheads are allocated precisely where the resources are being used. So, what did this reveal? If you look at the data, a single necklace absorbed 190 ringgit 43 cent in overhead costs. Compare that to a pair of earrings which only absorbed 99 ringgit 33 cent. This validates our pricing strategy. It proves that the high markup on our premium necklaces is not just for profit. It is necessary to cover the intensive service, security, and marketing required to sell them. In conclusion, our analysis confirmed that Aurelia & Co. is a financially viable venture. Our master budget project a healthy net income of 3,000 ringgit for the year, Furthermore, we end the year with a strong cash balance of approximately
65,379 ringgit 60 cent,
proving we can cover our obligation and sustain operation for the following year.
That is all from us, Group 11, with Aurelia & Co as our business name. Thank you for watching this presentation. Goodbye!